Hello everyone, welcome to ACCA P6 video lectures brought to you by AccountancyTube.com. We are still at inheritance tax. Now we will look at some more aspects of inheritance tax. If you could please move to page number 72 of your P6 lecture notes, please. Page number 72 of P6 lecture notes. We have seen the business property relief in our previous video. Now we are going to start agricultural property relief. Agricultural property relief, page number 72 of your lecture notes. Now it says APR usually reduces, it says reduce, it's not reduce, it's reduces, it's a typing mistake. Reduces the transfer of agricultural property by 100% of agricultural value. Now it says 100% of agricultural value. Please remember that there is a difference between market value and agricultural value. Examiners sometimes give you both values to confuse yourself, so you'll have to take the agricultural value, not the market value. Alright, so APR usually reduces the transfer of agricultural property, so it will reduce the transfer value by 100% of agricultural value. APR works like BPR in reducing the value being transferred by a certain percentage before any exemptions. Now APR is given before PPR. That is a very, very important thing to do. Let's say, for example, if both the reliefs are applicable on the same property, then we will give the agricultural property relief first. Right? Now, conditions for relief applicable for all of them, PAT, CLT and death estate. So for relief to apply, the transfer must either have owned the property and have occupied themselves for the purpose of agriculture for 2 years before the transfer. So individual must have owned the property and he has used that property for agricultural purposes 2 years before the transfer. That is one condition. If he does not use for agricultural property, purposes, he just own it, then there is a separate criteria. So in the B it says that own the property for at least 7 years before the transfer, during which it must have been occupied for purposes of agriculture by either the transfer or the tenant. So it means that you must have owned the property, but someone else might have used it for agricultural purposes. That is still fine, but in this case the ownership period is 7 years. Right? However, if you are using it and you are owning it as well at the same time, then the criteria, the condition is for 2 years. Now, if the property transferred replaces the other agricultural property, the condition will still be satisfied. If you have had one property and then you have sold it and you have replaced with other agricultural property, this condition will still be applied. So you will still get the APR if certain conditions are met. So what are them conditions? The transfer had occupied the property for the purpose of agriculture for at least 2 out of the last 5 years. So both accumulated duration of the both properties 2 years out of the last 5 years. Or the transfer has owned the property that someone else has used it for at least 7 out of the last 10 years. And after that it says exactly like BPR, APR is still available even if the transfer cannot fulfill either the criteria. So when would it still be applicable? So it was transferred on death of someone else, and when it was transferred APR was available at that time. So it was eligible for APR at that time. So in that case, APR would still be available if none of the other conditions applied. Right? Right then, so if you could move to on the next page. Next is the death estate. Now we have already seen death estate in our previous video lecture. It is exactly the same thing. So first we'll we'll look at the personality. So in that stocks and shares, insurance proceeds, personal chattels, cash, and if you have any dues, we'll deduct that, and the funeral expenses will be deducted. And after that we'll look at the realty, in which the property will be taken and we'll deduct the mortgage out of that. Right? And the net estate, that would be our net estate after deduction of the mortgage. And the gift with reservation will also be added in it. Now we haven't seen gift with reservation in our previous video lecture, which was for F6. So we will see gift with reservation. What are these in a moment? Sorry. Right. So that is our chargeable estate. And after that, some certain expenses are deducted. So we have seen them expenses as well in our previous video. Right then, after that, if you come to the next page, There is a death tax on death estate. Now it is also exactly in the same way which we have seen in our previous video. In order to calculate the tax on death estate, use the following steps. Look back 7 years from the date of death to see if any CLTs or PETs have been made. If so, these use the nil rate band available for the death estate. Work out the value of any nil rate band still available. Then we will excuse me, in the step 2 we will compute the value of the death estate, and up to the, if there is any nil rate band available, any part of the the death estate covered by the nil rate band will be at the rate of 0%, and anything on top of that will be at the rate of 40%. Right. On the next, the next one is a transfer of unused nil rate band. We have already seen that as well. So if one spouse has died and she had any unused nil rate band, so that will be transferred to the surviving spouse, and on her death it will be added in the surviving spouse's nil rate band. So say for example Mr. A died today and he had unused nil rate band, so unused nil rate band will be transferred to the wife. Now when wife will die, she will have their own nil rate band as well, and she will have her husband's unused nil rate band as well. Now when husband died, the nil rate band was, say for example, different amount. Now we will take that, how much was the percentage of unused nil rate band, and that percentage will be applied on the new nil rate band of the wife. Right, so it will be added like that. Right, then after that it's a grossing up of assets on death. Now what happens, we have seen the circumstances in our previous video when we were studying F6, that when an individual dies, it says that I will transfer this thing to my son, that thing to my daughter, and the other things to my nephew or whatever. And after doing all of that, he will say that I will transfer the remaining estate to that person, right? So he will specify that I will give that asset to my son, that asset to my eldest son, this iPad to my daughter, that car to my wife or whatever. So he will specify that I will be giving these assets to many different people. And then he will say the remaining estate will be transferred to that specific person. Now whoever is that specific person, we have seen that that person will be paying the tax. That person will be bearing the tax eventually. Now what happens is that is P6 part. Now if the person who has died, if he is transferring the assets to the chargeable persons, and he says that the remaining part will be transferred, I will give the remaining part, remainder of the estate, I will give it to the exempt party. Now what are the exempt parties? We have seen that wife is the spouse is an exempt party, qualifying political party is the exempt party, national purposes is the exempt party. So there were 4 altogether exempt parties. So if he says that the remaining part of my estate will be transferred to the exempt party, in that case we will gross up the estate. All right, so that's what it says. It will only apply when the remaining part of the estate is transferred to the exempt party. Now in the most cases in the question it will say that I will give my car to my son, I will give that house to my daughter, remaining estate I will transfer to my wife. Now in that case, it will be grossed up. Now how would we gross it up? We will take the chargeable amount in excess of the nil rate band, multiplied by 40 over 60. Right? So that's what it says. The value of UK estate must be grossed up on death before computing death tax when the UK death estate is transferred to chargeable persons. Now UK death estate is transferred to chargeable person and the residue is left to the exempt recipient. Now this can happen when the residue is left to the exempt recipient, like a spouse or a charity, right? Now if proportion of UK death estate is transferred to spouse, now sometimes if he says that I will give that house to my wife and the remaining amount to my son. Now what he's doing, he's giving the specific amount or specific asset to the exempt party and the remaining amount to the chargeable person, like son. Now in that case, grossing up does not need it, right? Grossing up is not needed in that case. Now after that it says foreign property needs not be grossing up, so foreign property is also does not need to be grossed up. Then after that, a reduced IHT rate on death estate. Now that is also important aspect of P6, that whenever we have given 10% of our estate to the charity, say for example, if an individual had estate and he said that I will give 10% of my death estate to the charity. If he does so, then the death tax rate of 40% will not apply. However, the reduced death tax rate of 36% will apply. Correct? So there will be discount only if the 10% of the death estate will be transferred to the charity. Now that 10% does not apply on the full death estate. It is after deduction of the all exemptions. Right? So 10% or more of the net death estate, which is assets less liabilities, less exemptions, less reliefs, less available nil rate band, but before deduction of the charity itself is left to the charity, then the death tax rate on death estate is reduced to 36% instead of the 40% normal rate. Now examiner can give you a situation where he will say that he was paying tax at the rate of 40% or whatever, then he is thinking to give the charity as well. What would be the impact if we give this much of amount to the charity? Now then you will have to determine that if it is 10% of net estate or not. 10% of net estate. If it is 10% of net estate, now in certain circumstances it could be possible that it would be 10% of the total estate, but it would be less than 10% of the net estate. In that case, reduced rate of IHT will not be applicable. Reduced rate of IHT of 36% will only be applicable when the charity amount is 10% of the net death estate, and net means assets less liabilities, less exemptions, reliefs, and available nil rate band. Right? But we will have to think about the charity, so we will not deduct the charity from this deduction. Right, then after that it's a gift with reservation on the next page. If you see, now this gift with reservation will be added in the death estate, as we have seen a couple of pages ago, right, when we were looking at the death estate. Now what is gift with reservation? Now sometimes what happens that an individual might give a gift. After giving the gift, he might be taking benefit of that specific property which was gifted. Now situation can arise when an individual has transferred a house to their children, but he continue to live in that house. Or other example of that is shares. Now I have gifted the shares to my daughter, then I continue to receive the dividends on that. So that is another example. Now in that case, it will be assumed that it is my death estate, so it will be added in my death estate when I die. Right? So that is gift with reservation, which means I've gifted, but I have reserved the benefits of them assets. Now this gift with reservation excuse me, this gift with reservation will not apply if I am giving the market rent on that house. Alright, so if, say for example, I have transferred the gift but I continue to take the benefits, but I'm giving the market rate of rent, then in that case gift with reservation will not apply. Now there are certain other rules as well. Let's read it. And now there are rules to prevent the avoidance of IHT by making the gift while reserving some benefits. The obvious example is gift of a home and then continue to live in that house. Right, and after that it says where gift with reservation is made, it is treated in the same way as other gift is made, so it will be either PET or CLT. However, special rules apply on the death of the donor. If reservation still exists at the date of the donor's death, asset will be included in the donor's death at the value at the time of death. So it will be included as in the death estate at the time when the death occurred, not at the time when the gift was made. Right? Now after that, if the reservation ceases within 7 years before death, now that is a second case. If the reservation ceases within 7 years before that, so I've made a gift of house and then I continue to live in that house, but then after some time I bought another house, so I lived in that house, and after 7 years I died. So if I cease taking the benefits within 7 years of death, then in that case the gift is treated as PET, made at the time the reservation ceased. So at the time when I left that house, so that would be the time of the gift. The annual exemption cannot be used against such a PET, so that will be considered as PET, but annual exemption of £3,000 cannot be used against that potentially exempt transfer. Right? Now there are certain exceptions to the gift with reservation rules. A gift will not be treated as being reserved if full consideration is given and the property is land or chattel. For example, an individual might give away his house and continue to live in it, but he pays market rent. So in that case, a gift with reservation will not apply. A gift will not be treated as being with reservation if the circumstances of the donor change in a way that was unforeseen at the time of the original gift. Now, when I given it a gift, I did not have intention of living in that house, but because after some time I got ill, I was so bad, my health was so bad that I had to transfer myself. I had to move into the house of my son, which was my house, but it is gifted now. So then I had to move in that house of my son. So I'm living in that house. So when I made a gift, I did not have intentions. I was not aware that I will get sick and I will have to move in that house. So in that case, the gift with reservation will not apply. All right. So that's what it says. Unforeseen at the time of original gift, and the benefit provided by the donee to the donor only represents reasonable provision of care and maintenance of the donor, being an elderly or infirm relative. So I had no intention of living in that house. I only moved in that house because I could not take care of myself. So my intention of moving in that house was only temporary. So until I get better, so that's why I'm moving in that house. Otherwise, apart from that, there was no intention. So in that case, the gift with reservation will not apply. Right? Right, then after that it says overseas aspects. Now overseas aspects are, as I said to you earlier as well, overseas aspects will be exactly the same for most of the for all of the taxation in F6 and P6. So double taxation relief apply to transfers during lifetime and on death of the assets situated overseas, which suffer tax overseas as well as the tax in the UK. We are talking about IST. Double taxation relief is lower of UK IST on overseas gross assets. So the double taxation relief which will be given, it will be lower of these two. So the tax which we have paid overseas on that same assets, and the tax which we will pay in the UK on the same assets. So it will be lower of these two. The UK tax on overseas assets and overseas tax on overseas assets. After that it says administration of IST. We have seen that as well in our previous video, so I don't think we need any more revision on that. And after that it says interest. So interest runs on from which date? So whenever we have made a late payment, so interest will run from that date. Tax arising on free estate at death is payable within 6 months from the end of the month in which the death occurred. Interest runs from the 6 months after the end of the month when the death occurred, so it is from the same date. Taxation arising in representative of pets and CLTs, where we have to pay additional tax within 6 months from the end of the month of death, it will be paid on that date, and interest will be from the interest will be due from this date. Now, in certain circumstances, we can pay the IST on certain assets in installments, in 10 equal installments. The first installment will be paid on the normal due date, and then there will be 9 equal annual installments after that. The installation can only be paid on IST of these assets. So land and building, shares or securities in a quoted company where you have a control immediately before the transfer, or shares in an unquoted company where you hold 10% shareholding, and the value for IST purposes is not less than £20,000. Right, and after that, a business or interest in a business. So if you have a partnership, in that case as well. If the property is sold, then all outstanding tax must be paid. So if you have eventually sold the property, then all the tax, all the inheritance tax will be paid immediately, whatever the remaining amount is. Right, then after that it says altering disposition made on death, on the just beneath that. Now what does it mean? Now when an individual died, when someone's parent died, now they have written a will that I will transfer this asset to that son, I will transfer this asset to that daughter. So they will specify that which assets will be transferred to which kids. Now the kids after dying, when the parents die, after that kids sat down and then they thought it is not an appropriate apportionment of the assets. Now then they might decide to change the will. Now then they will sit together and then they will decide with mutual agreement that these assets should be distributed according to their mutual agreements. Then they can change the will of the deceased person. Right? So that is a change of the will. Now there are two main ways in which the disposition on death may be altered: by application to the court and by means of voluntary variation or the disclaimer of legacy. Right? So that's it. On the next page, if you see, page number 77. Now, and anyway, if let me move to the page number 77 first. Right then, advantages of making lifetime transfers. Now we have already seen that what are the advantages of making lifetime transfers in our previous video, and factors to consider when choosing to gift during our lifetime. So we have seen that as well. There are certain additional aspects here which we haven't seen in our F6 video. Like it should be considered that whether or not significant CGT will arise as a result of gifting the asset during our lifetime. Now whenever we are gifting an asset during our lifetime, we will have to pay capital gains tax as well. We might have to pay capital gains tax. So we'll have to see them aspects as well. Therefore, the availability of CGT exemptions and gift relief should be considered before making the decision to gift the asset. It should be considered that whether the donor can afford to make the gift. It is important to consider that making the gift, whether the donor will be able to live comfortably in that old age, and then all of them are exactly the same. Now, just before that, and just beneath that, it is what are the consequences of IST and CGT on the same gift of assets. First of all, it is a potentially exempt transfer during lifetime. CGT will have to be paid and will take market value as sales proceeds, and gift relief may be claimed. Now CLT as well, CGT will be paid when it is a CLT during lifetime, so transfer of asset in a trust. What would be the CGT implication on that? CGT payable in the tax year of transfer market value will be used, and gift relief may be available. Now additional tax paid on PET and CLT, so when the asset is transferred at death, say for example, or after making the transfer, individual died within 7 years, so there will be additional tax payable. In that case, no CGT will be payable, and there won't be any CGT on death as well. Gift with reservation during lifetime, there will be CGT, and on death there won't be. Again, if it is a lifetime, CGT payable in the tax year of transfer, market value will be used, and gift relief might be claimed. Right, so that is the end of our chapter capital gains tax. Let me do a question with you. If you could open your BPP exam kit for me, please. If you could open your BPP exam kit, and that is question number, let me see which question number it is. Question number 15 of your BPP exam kit, please. Question number 15, name is UNA, U-N-A. It was examined in June 2012. It's a huge question, 35 mark question. So we're going to do this question. And just bear me 1 second. Before we start doing this question, let's look at another small topic as well, which is on your notes. If you come to page number, let me see which page number it is. It's page number 60. Page number 63. Sorry, page number 62 of your lecture notes, please. I won't be sharing the screen with you. Just come to page number 62. Page number 62 of your P6 lecture notes, please. Page 62. Let me open that page as well. Page 62 of your P6 notes. If you look at the last heading in here, penalty on dishonest conduct by tax agent. Last topic is penalty on dishonest conduct by tax agent. Now it is just a small, it looks like it is a very small amount of data in here. It's a small topic, but it is very, very important for P6 purposes. I would say 9 out of 10 exams in P6, there would be this topic examined in the P6. 9 out of 10, or even we can say 10 out of 10. It is always examined for 5 marks minimum. It is basically ethical part of the P6. So ethics will always be examined. Please make sure you mark it as very, very important. And it is very, very easy. So there will be typical same sort of questions in the exam. So examiner, I've seen all of the exam papers from past 5 to 7 years. So there will be this question every time, and the style of the question will be exactly the same way. So it will be incorporated, it can be incorporated in any of the questions, but the style would be exactly the same. So in the question, it could say that it will give you the information where the client is trying to play up with the rules, the client is trying to hide the tax, or it is avoiding the tax in an illegal way. Then your manager will ask you, what should we do? In that case, you will have to write a letter to client, and you will have to inform them that you are not doing it right. What is the right treatment? Then you will tell the right treatment if there is any. And after that, you will convey the message that we cannot hide the things from HM Revenue and Customs. We will have to communicate these things to HM Revenue and Customs, and we will have to tell HMRC that what is the right amount of tax on that. If you cannot do that, let us do that on your behalf. We will write to HMRC, and we will tell what would be the original liability. Or if you're trying to hide any source of income, we will have to tell that to HMRC as well. Right, so we can't hide anything from HMRC. We can't lie them. Right. So after telling that, if the client does not agree, then we will have to tell them that if you do not agree with us, then unfortunately that we will not be able to represent you, and we will write to HMRC as well that we are no longer associated with that client. Right, and although we will tell HMRC that we are no longer associated with that client, but we will not tell them the reasons why we are ceasing to act for that client. But in most of the cases, when we are writing to HMRC that we are no longer associated with that client, HMRC will already know that something fishy is going on. So they might start an investigation anyway without telling, even though we will not tell them. All right. So we will have to communicate that to your client as well, that we will write to HMRC telling them that we are no longer representing this client, although we will not tell them the reasons. All right. So that would be the typical exam question, and that is the answer. That is the way to answer, and it is very, very easy. 5 mark, very easy 5 marks, and it is examined in almost every sitting. Now, if you could see the question, page number 62, last part of the page number 62, a penalty on dishonest conduct by a tax agent. Now, HMRC can investigate dishonest conduct of tax agents and apply a penalty of up to £50,000 where there has been dishonest conduct and the tax agent fails to supply the information or documents to HM Revenue and Customs has requested. If a client intends to evade the tax by providing the false information or concealing any information, then the tax agent should advise the client to disclose the information with honesty and integrity. The tax agent must not be involved in tax evasion activities of the client and must disengage from such a client. All right, so we will tell them that if whatever you are doing, it is not right, and we can't assist you with that because it is against the professional behavior and integrity. Right. So that was I just told you this is important topic, because the question which we are going to do now, it is part of that question as well. So that's why I asked you to open up this thing. Now, if you could come to question number 15 of BBB exam kit. It was examined in June 2012, and question name is owner. Let's read the part B for this question for now. If you read the requirement, it is 8 marks worth. Prepare the letter requested in the email from your manager. So what is it asking us to calculate? On the previous page, if you come, part B, it says undeclared income. If you see part B, undeclared income. Now, a brief letter to be sent from me to owner in relation to the luxury motor car The letter should explain the implications for owner and our firm of failing to declare the income to HM Revenue Customs, and the implications of owner of not having declared the income sooner. Now, on the first page where the question starts, last heading is undeclared income, so we'll have to read that. Owner purchased a luxury motor car for her own use in 2014, but found that many of her friends wanted to borrow it for weddings. In June 2015, she began charging £200 per day for use of the car, but is of the opinion that the income received cannot be subject to income tax, as she only charges a fee to help cover the car's running expenses. However, I have considered the situation and concluded that hiring out of car has resulted in taxable profits. Right? Now, we have already concluded that it resulted in taxable profits. Now, our manager says, write a letter from me to be sent to the client, in which we will say that what would be the consequences of hiding the stuff from HM Revenue Customs for them and for us. All right? And implications of owner for not having declared the income sooner. Now, a typical answer of that question would be that we will first tell them that the income earned from the car, because you are renting it out, so it is subject to income tax, and you will have to pay income tax according to the tax bands. Now, the expenses which are incurred for the purposes of the business, that can be deducted out of that income, and on the net income, the income tax will be payable. Now, we cannot just hide this information from HM Revenue Customs, and you will have to disclose this source of income to HM Revenue Customs as soon as possible. If you cannot do that, let us do that. We will tell HMRC about this source of income. However, if you do not agree in disclosing this source of income to HM Revenue Customs, unfortunately, we will not be able to be associated any longer with you. Because it is against the integrity and professional behavior. We are bound by our profession to act with integrity and professional behavior. If you do not agree, we will have to tell HMRC that we are no longer associated with you, and although we will not tell them the reasons why are we doing so. All right? And for you as well, if you are hiding this stuff from HM Revenue Customs, it is considered evading of tax, which is a criminal activity, which is a criminal offense. And in certain circumstances, if you're hiding stuff from HM Revenue Customs, the maximum penalty could be 70%. However, it could be minimum of 20% as well, if you can satisfy HMRC that it was just an omission. All right, so you will have to tell them all these things to the client. Your client will be aware. So it is very easy part of the question, which will be examined in almost every question, almost every exam. As I said, out of 9 out of 10 exams, this question is always examined. It is an ethical part of the question, which is very easy. And in every question, the style of answering the question will be exactly the same. If you're following the exam kit, if you have done enough questions of the exam kit, you will see that there will be lots of questions. Almost 4 or 5 questions, I think, in the exam kit are exactly in the same way. And if you see the answer of them questions, it is exactly written in the same way, because the style of the question was same. All right, so there is no variation in the type of the answers. Right, so if you read the question number, the part A of the question, prepare the memorandum requested in the email from your manager, and note for guidance in part A of the question are worth no more than half of the total marks available. So it says the calculation marks are half of the commentary marks, so you'll have to write it in commentary style as well. Right, then on the page number 2 of the question, so where the question starts, next page of that, in part A it says, I want you to prepare the following. I want you to prepare the following. In A it says, give to a son and a granddaughter a memorandum for the client file that addresses the following issues. So there are issues from 1 to 5, and then in A2 it says, in respect of the payment to Alona's rent. Now Alona is granddaughter. It says that conditions that would need to be satisfied in order for payment to be exempt from the purposes of inheritance tax. Right? Now what is Alona's rent? If you come to where the question starts, it says give to granddaughter. If you see, it says give to granddaughter on page 1 of the question, where the question starts. Give to granddaughter. And it says that owner's granddaughter Alona will begin a 3-year university course in September 2018. Una has agreed to pay Alona's rent of £450 per month while she is at university. Now, what would be the conditions that this will be considered as exempt from IST? So this gift will be considered as exempt. Now, it will only be exempt if it is normal expenditure out of the income. She is paying it out of the income, not capital. It will not harm her way of living, and it is an extra amount. Now, how much she is paying? She is paying £450. If you multiply by 12, whatever this amount is, if this amount is extra, and if this is an extra amount out of her income, then if she can prove that, then it will be exempt. It will be considered as normal expenditure out of income. And we have read the conditions from our notes, that what are the normal expenditure out of the income, and it is paid out of the income, not not capital, and it will leave you in the same lifestyle as you were before, and then you will have to account for how much is the value. After that, if we so that part of the question is answered as well. Now, if you see part A1, it says a memorandum for the client file that addresses the following issues in respect of the gift to one. Now, who is one? One is a son of the donor, right? Calculate the calculation of the potential reduction in the inheritance tax payable on owner's death as a result of each of the possible gifts to one. Farmland will not qualify for business property relief, but you will have to consider the availability of the agricultural property relief. Calculation of the capital gains tax liability in respect of each of the proposed possible gifts. We'll have to calculate the capital gains tax as well. Explanation where calculations are not self-explanatory, particularly in relation to the availability of reliefs, and a note of any assumptions made. A concise summary of your calculations in relation to these capital taxes in order to assist owner in making her decision as to which asset to give to one. Any of the tax and financial implications in respect of the gifts to which owner should be aware before she makes her final decision. So we'll have to consider that. Now, she is making the gift, so where the question starts, we'll have to read that information. Now, I have had a meeting with owner, a new client of a firm who was born in 1944 and is the widow. She has a son, Vaughan, who was born in 1969. Una is resident and domiciled in the UK. Her annual taxable income is £90,000 approximately, so she is a higher rate taxpayer. She makes sufficient capital gains each year to use her annual exempt amount. So when we will be calculating the capital gains tax, she will have already used annual exempt amount, so we cannot deduct the annual exempt amount. So we'll calculate the capital gains tax straight away. Una made a gift of £40,000 to Vaughan in 2014. She made a gift of £40,000 cash to 2014. This is the only transfer she has made for the purposes of IST in the last 7 years. Owner has left the whole of her estate to Vaughan in her will. Her estate is expected to be worth more than £3 million at the time of her death. Right, so her estate is more than £3 million, and the whole amount is transferred to the Vaughan. Una had left, we've studied that, we've read that. For the purposes of this work, I want you to assume that Una will die on 31st of December 2023. So for the purposes of this work, we will have to assume that Una will die on 31st of December 2023. And after that it says the gift information about the gift to son. Now Una is considering making a gift to Vaughan of either some farmland situated in England. So there's one possible gift of farmland, or a residential villa situated in the country of Siluria. So villa is situated in overseas country, where the farm is situated in England, which has always been rented out. Una has prepared a schedule setting out the details of farmland and the villa. This schedule is attached to this email. Una will make the gift to Vaughan on his birthday on 18th of November 2018. So the gift will be made on 18th of November 2018, and it says that she is not prepared to delay the gift, even if it would be advantageous to do so. She is not willing to delay it, even if it is beneficial for tax purposes. So the gift will be made on 18th of November 2018. The tax system in the country of Siluria. So the tax system in the country of Siluria is given. There is no capital gains tax in the country of Siluria. If owner still owns the villa at her death on 31st of December 2023, the IST liability will be £170,000. If owner gives the villa to Vaughan on 18th of November 2018 and dies on 31st of December 2023, the inheritance tax liability in Siluria would be £34,000, all of which would be payable following the death. Double taxation agreement between the UK and the country of Slovakia includes an exemption clause. So that is a double taxation agreement, which says that when a tax has been deducted on same amount of income in one country, the tax will not be applicable in other country on the same amount. All right, and after that it says gift to granddaughter. We have already done that part. Right then, now there are two possible gifts. One is a farmland situated in England, and another is a villa overseas country. Then we have to see that how much would be, what would be beneficial for IHT purposes, to give during lifetime or to be part of death estate. Which one is beneficial? So we'll have to account for both of them. So basically she is willing to give it during lifetime. So if she would not have given it lifetime, it would be at death. So then we will have to see that how much is tax how much would be the tax if it is included as part of the death estate, and how much is if it is gifted during lifetime for both of these assets, and which one is beneficial to give during lifetime, because she is going to give it on the date of birth of her son. Right? And on the next page, attachment schedule from owner, details of the farmland and villa. So this is the information of farmland and villa. Cost is given, value on the date of gift is given, and the value at death is given as well. And beneath that there is some other information. Right then, if we just do this question for now. Now first of all, we'll have to see the which one is it? Villa. So tax on villa in which country is it? Slovakia. If tax if kept till death. So how much is the tax if she kept till death? It will be £170,000 if it is part of our death estate. So it will be £170,000, and tax if gifted during life, it would be £34,000, right? So that will be £34,000. Now we'll have to see the difference. So if she give it at death, this information is given, it is £170,000 tax. However, if she give during lifetime, the tax would be £34,000. So how much is the difference? £36,000. Right, so that is a tax saving if gifted during lifetime. If gifted during lifetime. Right, so that is on villa in country of Slovakia. Right, so if gifted during lifetime, that would be the IHT savings. IH tax, inheritance tax savings, if gifted during lifetime of £36,000. Right. Now we haven't considered the UK tax, because tax has already been paid in the country of Slovakia. So that's why there won't be any more tax in the UK, because there is an agreement between these two countries. Now we will have to see the capital gains tax as well, because there is no capital gains tax in the country of Slovakia. So we will have to see the capital gains tax on the villa in the UK. Then we will have to see the net effect. What would be the capital gains tax? What would be the tax savings with that? What is the net effect on that? We'll have to see that. All right. Now, anyways, sorry, it is not 36,000, but it's 136,000 pounds. 136,000 pounds. All right. Now we'll have to see about the farmland as well. Now let's see about the farmland. UK IST. What is the value? So if it is gifted during lifetime, value of the farmland, if you see the attachment, value of the farmland on 18th of November 2018 was £900,000. Right, so value on date of gift, it is £900,000. Then we'll have to deduct the annual exemptions. Now, it was gifted in the tax year, it was gifted on 18th of November 2018. Which tax year is it? It is tax year 18-19. So we can use annual exemption of 18-19, current tax year, and we can use the annual exemption of previous year as well. So less annual exemption. So annual exemption. And annual exemption we can use 18-19 and 17-18. So it will be 3,000 plus 3,000. So we can deduct £6,000 out of that, and it would be, if we deduct 6,000 out of that, it would be £894,000, right? So that would be £894,000. Now, that is a gift of the farmland if it was gifted during lifetime. But please remember, we are not calculating a lifetime tax on that. We are calculating the death tax on that, because it was a potentially exempt transfer. And when it is a potentially exempt transfer, there won't be any lifetime tax. However, there will be a death tax if someone dies within 7 years. Now, because he gifted on 18th of November 2018, and then he died within 7 years, so that's why there will be death tax on the same gift. However, there was no lifetime tax on that. So that is we can write it down, death as well. So death UK inheritance tax if farmland was gifted during lifetime. So that is basically death tax on potentially exempt transfer, because there is no tax on potentially exempt transfer during lifetime. All right, so that is £894,000. Right then, so up to the nil rate band. So if we calculate the IHT, so IHT, £325,000 at the rate of 0%, £569,000 at the rate of that is a death tax at the rate of 40%. So times 40, that is 227,600. Right, so that is 227,600. And then we will have to consider, because this individual, gifted on 2018. What is the date exactly? Let me see. It's 18th of November 2018. So the gift was made on the 18th of November 2018, and he was died on what date? 31st of December 2023. So how many years are these? So 2018, 19, 20, 21, 22, 23. So this is from 5 to 6 years. So we know that there will be taper relief as well when the individual died within more than 3 years. Right? So there will be taper relief as well. And if it is more than 5 and less than 6 years, the taper relief would be 60%. So taper relief will also be deducted. Taper relief at the rate of 60%. And 60% of what? 60% of 227,600. So we'll have to deduct the taper relief. Let me calculate it as well. Times 60%. So it is 136,560. So if we deduct that out of that, that is 91,040. That is the tax. Now we have used the nil rate band on this gift. We have used the nil rate band. Now if we would not have used this nil rate band here, we could have used this nil rate band on the death estate. Now please remember, this is not death estate. This is additional tax payable on death, right? Because there was no tax during lifetime on pet anyway. So that is a tax paid on death while the gift was made during our lifetime. All right. So if we would not have used the nil rate band here, we could have used this nil rate band in the death estate. So we are paying additional tax. We will be paying the additional tax on death because of not having the nil rate band. So we will have to use that as well in here. So we'll have to incorporate this cost. So we will be paying additional tax at the rate of 40%. So 325 at the rate of 40%. So that additional tax will also be paid on death estate. So we'll have to incorporate that as well. £325,000 times 40%, that is £130,000. So if we add this one into 91,040, that is 221,040. Right, so there is a cost if we give during the gift, if you give the gift during our lifetime. So cost is 221,040 if we give it a gift during our lifetime. Right? Now, if we do not give it during our lifetime, if this amount is not given during our lifetime, if we give it, if it is part of a death estate, so if we do not give it during our lifetime, it would be part of the death estate. Now, if it is part of the death estate, what would be the tax on that? Now we'll have to see death tax as death tax as part of death estate. Death tax as part of death estate on farmland. Right, so we'll have to see the value at death for that. So value at death is 1.1 million. So value at death. Value at death is 1.1 million. Right, and we know that date of death is 31st of December 2023. All right. Now, when was it bought? It was acquired on the September 2015. It was acquired in September 2015, which means it has been held for more than 7 years. And it says in the notes, it says agricultural value of the property is approximately 35% of its market value. The farmland has always been rented out to the tenant farmers. Now, it has always been rented out to the tenant farmers. Now, if he would have owned it and rented it, if he would have owned it and used it for agricultural purposes, then there were only 2 years required, because it was owned but rented to someone else, to the farmers to use it for agricultural purposes. In that case, in order to qualify for agricultural purposes, agricultural relief purposes, the duration is 7 years. All right, so he qualifies for agricultural property relief, so we'll have to deduct the agricultural property relief out of that. So APR, 100% of agricultural value. 100% of agricultural value, and agricultural value, it says 35% of its market value. Now, market value is 1.1 million pounds, and 35% of that would be how much? Yeah, so it is 35% of market value. So it would be, let me see on the calculator. So it is 1.1 million. So times 35%, 385,000 pounds. So that would be deducted out of that. So 385 less 1.1 million. That is 715,000. Right? Now on that we will have to pay tax at the rate of 40%. Please remember, we cannot use the the nil rate band against this amount, because a nil rate band would have already been deducted. Nil rate band will already been used. A nil rate band will already be used, because there will be additional tax on the lifetime gifts as well. So it will already has been used against the other assets. So we will not be using against this. Nil rate band cannot be used against this, because it will already been used against other assets. So it will be 715 at the rate of 40%. So let's see how much it is at the rate of 40%. So that is the tax at the rate of 286,000 pounds. That is our IHT. Right? So IHT is 286,000 pounds in this case. Now that is our IHT as part of death estate. Now we have to see the difference between these two. So that is the figure, and this amount 221,040. So if it is part of if it is part of the death estate, the IHT is 286,000 pounds. If it give it as a gift during the lifetime, the death tax is 221. So we are better off giving it a gift during our lifetime. How much are we better off? So we'll have to see the difference between these two. 286,000 less 221,040. So whatever the difference of this amount is, 64,990. So we are better off 64,990. So we are better off by this amount if we give it during our lifetime. Now, now we have to see the difference between the two gifts. One is a villa, and other one is a gift of farmland. On the farmland, we are saving 64,990 if we give it a gift during our lifetime, and we are saving 136,000 pounds if we give it a gift during our lifetime of a villa in Soloria. Now these are only IHT aspects. If we have to see, but we have to see the capital gains tax aspects as well in order to quantify the exact amount how much we will be saving. Right now we'll have to see the CGT on villa, because there is no CGT in the UK, there is no CGT in the Soloria, so we'll have to see the the capital gains tax on the villa in the UK. So let's see the value in the question. If we move now for the villa, it says the market value on because it is a gift of the villa, so we will use a market value. All right, so market value of the villa, so take market value of villa. It is given to us in the question. It is 745,000 pounds. So that is 745,000 pounds market value of the villa. Now it was actually acquired on August 2014, but if you read the information beneath that, I inherited the villa when my husband died on 14th of January 2018. Its market value at that time was 600,000 pounds. So we'll take that value when she inherited from her husband. Right? So we won't take when husband acquired it. We'll take when the husband transferred, when it was transferred to the wife. So we'll take 600,000 pounds market value when inherited by whom, whatever the taxpayer's name is, owner, by owner, right? So what is the difference? 145,000 pounds. So 145,000 pounds is the chargeable gain. Now, as I said to you earlier as well, that it is a gift. That's why we'll take the market value. But because it is an investment property, it is not a business asset, so gift relief will not be available. So we'll have to pay the tax. And another thing as well, it is a villa, which means that it is a residential property. So we will have to charge a residential rate, 18% rate up to the basic rate band, and 28% for the higher rate, because we know that he has already used. In the question, we were told that he will always use the annual exempt amount. So annual exempt amount is not available, and he's a higher rate taxpayer. So 28% of the rate will be applicable. 28% times 145,000 pounds. 145,000 pounds. So that will be the rate of tax. How much is the tax? Let's see on the calculator. So just give me 1 second. So 145,000 pounds times 28%. So that is 40,600. That is the capital gains tax, right? Now this 40,600, which is the capital gains tax, this will be deducted out of that. So 40,600. That is a CGT, and the net figure less 136,000 pounds. That is a net benefit of 95,400. Right, so that is a net benefit. Net benefit of what? Net benefit of making a transfer during our lifetime. As I said, whenever we are making a lifetime transfer, we will have to consider the CGT aspects as well, because whenever we are making a lifetime transfer, we will be paying capital gains tax as well. right? So that was for villa. We will also have to see the capital gains tax for a farmland as well. So what is the market value of the farmland? Market value of the farmland at the time of gift was £900,000. So market value is equal to £900,000, and cost was how much? £720,000 is the cost. So that is the cost. Remaining amount is how much? £180,000. Right? Now again, it is a farmland. Business property relief is not available. So the tax will be at the rate of 20% because he's a higher rate taxpayer. Annual exempt amount is not available. So at the rate of 20%, and it is not a residential property. Right? So it will be at the rate of 20% at times £180,000. So it is going to be £36,000. So £36,000. Now this £36,000 is a capital gains tax. So that is a CGT. Now this £36,000 will be deducted out of this benefit of 64,990. All right. So 64,990 IHT saving. That is our IHT saving less CGT, which is how much? £36,000. That's £36,000. So we'll have to see the difference. How much is the difference? £36,000, 64,990. Difference is 28,990. And whereas the saving was 95,400 in the case of villa, right? So which tells me that we are better off. If we give a gift of villa during our lifetime, because if we give a gift of the farmland, we will have to pay. We will be saving at the rate of, we will be saving 28,990. Right? And in the question it says that we will have to see the other aspects as well. So other aspects, if we see that he's going to die in 2023, now if he survives for another 1 year, then we will be saving another taper relief as well of 20%. And if he survives for another year, then it will be exempt, so 100% will be exempt. And we will also get the new ban as well, £325,000 on the death estate. So there will be another benefit of that as well, right? Also, if we see that the stamp duty tax on the land in the UK, so the farmland in the UK is not subject to the stamp duty tax. However, we will have to consider we'll have to see the rules for stamp duty in the country of Silurius. We are not aware of that. As far as the transfer of these assets is concerned, because he is generating income out of these assets, and income tax rate in the country of Siluria is at the rate of 50%, and whereas in the UK, even if it is a higher rate taxpayer, there will be at the rate of 40%. So there will not be any additional tax in the UK. All right. Likewise, and likewise for the capital gains tax, for the tax year 1819, because it is a tax year 1819, so it will be ending on 5th of April 2019. So the due date will be 31st of January after the tax year ending. So 31st of January 2020 will be the capital gains tax. Capital gains tax will be payable on that date. Now, in certain circumstances, the capital gains tax liability can be paid in installments as well. Now, that is also part of this, part of the answer of this question. But we will see later on when we move to corporation tax. So we will see later on in what circumstances can we pay the tax in installments. All right. Now, just bear me 1 second while I open up the notes. Right, so yeah, that's it for this video. Now please make sure that you redo this whole question. Now I've just done the calculation bit, but you will have to communicate to the examiner all of these things in detail in a commentary style. Now say for example, why we took this amount, all right? Likewise, we will say that this information was given to us in the question, and this also information was given to us in the question. So what would be the next net savings? So every bit of the information which was given to us in the question we'll have to we will have to communicate to the examiner. Likewise, these annual exemptions. So because the current tax year of the gift was tax for 18-19, we can use current year's annual exemption, and we can use the previous year's one as well. Likewise, you'll have to say that it is a potential exempt transfer. There won't be any lifetime tax on that. However, because the individual is going to die within 7 years, that's why there will be less tax on that. And then, why would the taper relief will be available? Because he survived for more than 3 years, and in this case 5 to 6 years, so that's why 60% will be taper relief. So that's why what you have to communicate as well. And available nil rate band as well. So you'll have to communicate that nil rate band is £325,000. So up to that, there will be at the rate of 0%. Why it is 40%? Because it is the death tax, so that's why it is a 40%. And if we come to the death estate, in that case as well, that value at death, so this was given to us in the question. APR 100% of agricultural value, because the agricultural value will be 35% of the market value. So that's why we took this amount. So you will be making the notes in which you will be writing all that stuff, right? And this bit as well. So basically, whatever information is given in here, you will have to communicate that you know these rules. You haven't just copied and pasted it. You know these rules, so you will have to communicate all that stuff to the examiner. And in this case, say for example, if we talk about the capital gains tax, we will have to communicate that gift relief will not be available because it's investment property. Likewise, in this case as well, it is an investment property, and the annual exempt amount is not available. It is a higher rate taxpayer. It is a residential property. So you'll have to communicate all that stuff to the examiner. Examiner cannot give you the full marks just by looking at the calculations and the figures. So you'll have to communicate to the examiner that why you took this amount. All right, so I will see you in the next video lecture, and we will do another question of inheritance tax as well. Then we will move on to corporation tax. I'll see you in the next video then. Goodbye.